We all hear about the snowball effect and compounding. Invest, reinvest, and let time do the work. But there's one detail that usually gets skipped. For compounding to actually feel like it's working, you need around $100,000 behind it. That's when growth becomes noticeable and momentum shows up. The problem is obvious. Most people don't have $100,000. So the real question becomes, how small can you start and still get the dividend snowball moving? In this video, I'll show you why the beginning feels slow, why $100,000 is where everything changes, and the fastest way to reach that point using a portfolio built on clear, easy-to-follow criteria. You'll see how John takes two different paths to $100,000, one with the smallest upfront investment and the other with simple single-digit daily contributions. And by the end, I'll show you how both paths reach $100,000 quickly and ultimately build toward $1 million portfolio that pays over $5,000 a month in dividends. Now, to make all this work, you first need to understand why the beginning feels so slow. If you've ever tried investing, this part will feel familiar. You save some money, you invest it, you reinvest the dividends, then you wait. You check your account weeks later, maybe months, and it barely looks different. The balance hasn't moved much. The income feels almost invisible. That's usually the moment people start thinking compounding doesn't actually work, but nothing is broken. The problem isn't compounding, it's what we expect it to look like early on. See, at the beginning, the numbers are supposed to feel small. Say you invest $5,000 into a dividend portfolio earning 3%. That gives you $150 a year, not a month, a year. Even if those dividends grow fast, maybe 10 or 12%, the next year you're looking at around $165. That's a $15 difference over 12 months. You don't feel that. It doesn't change your behavior. You can reinvest every dollar and the math technically compounds, but you're stacking small numbers on top of small numbers. The system is doing exactly what it's supposed to do, it just doesn't have any weight yet. This is where most people get tripped up. Compounding is not driven by time alone, it's driven by scale. Time only amplifies what's already there. When the base is small, growth is small. When the base grows, growth accelerates automatically. John went through this phase too. His portfolio wasn't wrong, his strategy wasn't wrong, it just hadn't reached a size where the progress was easy to notice. Nothing is broken in this phase. There's no mistake to fix. The only missing ingredient is mass. Until the portfolio reaches a size where gains can stack on top of meaningful gains, progress will feel slow. That's normal. Everyone goes through it. The people who succeed are not the ones who found a better strategy. So what actually makes compounding speed up? Well, it comes down to time, but not in the way most people think about it. Time doesn't add returns, it multiplies them. Suppose you start with $100,000 growing at 8% per year. After 10 years, it becomes about $216,000. After 20 years, it grows to roughly $466,000. That's steady progress, but it still doesn't feel dramatic. Now change one thing. Let it run for 10 more years. With no extra money and no better strategy, that same $100,000 grows to over $1 million. Those extra 10 years allow your money to earn on its own earnings. Early gains grow large enough to create much larger gains later. That's why the curve steepens near the end instead of the beginning. Growth rates amplify this effect. At 6%, $100,000 becomes about $574,000 after 30 years. At 8%, it reaches about $1 million. At 10%, it grows to roughly $1,745,000. A difference of 1% or 2% sounds small, but over decades, it completely changes the outcome. This is where people usually focus on the wrong part. The early years barely move the needle. The later years do most of the work. Compounding is backloaded. The biggest results show up at the end. This also explains why starting earlier often beats starting bigger. A smaller amount with more time can outperform a larger amount with less time. Time lowers how much you need up front and increases how much patience pays. When John started running the numbers this way, something stood out. No matter how the assumptions changed, the math kept circling the same idea. There was a point where time and growth finally became visible. Not because the rules changed, but because the portfolio got big enough for them to work together. And when you let the math run long enough, one number keeps showing up. Around $100,000 is where compounding starts to feel different. Not because anything magical happens, but because the numbers finally get heavy enough to matter. Below that level, growth is real, but it's quiet. You don't feel it. A $25,000 portfolio earning 3% produces about $750 a year. That's easy to ignore. It doesn't change how you think. It doesn't change how you act. Now take that same portfolio at $100,000 at the same 3%, it's producing $3,000 a year. That's noticeable. More importantly, you can reinvest it meaningfully. Reinvesting $3,000 each year starts buying noticeable new income, and when dividends grow, the effect compounds faster. If that $3,000 grows at 10% annually, it becomes roughly $7,800 per year after 10 years without adding a single new dollar of your own. That's why $100,000 comes up so often in long-term investing conversations. It's not a magic number, it's a practical one. It's where gains start stacking on top of gains in a way that you can clearly see. It's important to be clear about one thing. Compounding doesn't start at $100,000, it starts at $1. What changes at $100,000 is visibility. The snowball finally has enough weight for gravity to help. Growth becomes more consistent, more forgiving, and more resilient to bad years. Now, in a couple of minutes, I'll show you a portfolio that accelerates that process. And at the end, I'll show you John's two paths to a $1 million portfolio paying over $5,000 a month in dividends. One uses the lowest one-time payment needed, and the other gets there using the lowest daily contributions possible in single digits per day. So up until now, the focus has been on size, how much money you have and when compounding becomes visible. This chapter shifts the focus to direction, not how much income you earn today, but how fast that income can grow over time. For this, you need to understand a couple of things, first of which is the dividend yield, which tells you what's happening right now. Meanwhile, dividend growth tells you where things are headed. A high dividend yield feels good because it pays you immediately. Cash shows up, it feels productive, but if that income barely grows, it slowly loses power. Prices rise, inflation eats into it, time stops helping. The income stays flat while everything else gets more expensive. Dividend growth works differently. Instead of paying you more today, it commits to paying you more tomorrow, and then more after that. And more after that. Each increase builds on the last one. Over long periods, those increases matter more than where you started. This is why growth changes the outcome. Compounding doesn't care about comfort, it cares about momentum. Income that grows faster gives compounding something to work with. Every year, the base gets larger. Every reinvestment gets heavier. The system gains speed without asking you for more effort. This doesn't mean yield is bad. Yield helps you get started, but growth decides how far you go. And for that to work, the businesses behind those dividends have to be strong enough to keep raising them, which brings us straight to the checklist that actually matters when you're building a portfolio meant to compound. Compounding only works if the businesses underneath it can support it. Weak foundations give out long before compounding has a chance to build momentum. The goal here isn't to find exciting companies, it's to find reliable ones. Businesses that generate consistent cash year after year and have a clear history of sharing that cash with shareholders through dividends. You need stocks that have a long track record of paying and raising dividends. Payout ratios play a big role here. When too much of a company's earnings go toward the dividend, growth becomes fragile. Healthy payout levels, which are below 70%, leave room for increases even during tougher periods, which keeps the income stream moving forward. Earnings growth is the next checkbox. Dividends rise when profits rise. Companies that grow earnings over time can increase payouts naturally without stretching themselves. Finally, and very important, keep everything simple. A portfolio designed for compounding should not require frequent changes. Low turnover reduces mistakes, taxes, and emotional decisions. The objective isn't to react, it's to hold. Strong businesses, growing payouts, sustainable finances, and patience. That combination doesn't look exciting in the short term, but over decades, it's exactly what compounding needs to work properly. John applied the checklist and started with SCHD, the Schwab US Dividend Equity ETF. This became the income anchor in his portfolio. SCHD currently offers a dividend yield of about 3.79%. Over the last 10 years, its dividend has grown at roughly 10.61% per year, while the share price has appreciated around 7.88% annually. Income shows up early. That income keeps growing, and the price moves steadily without depending on any single company. Next came Abbott Laboratories, ticker ABT. The dividend yield here is around 2.02%, so the income starts smaller. Over time, it builds. Dividends have grown about 9.41% per year over the past 10 years, and the share price has appreciated roughly 10.74% annually. ABT represents stability and consistency. It doesn't pay much up front, but it compounds through earnings growth and reliable dividend increases. Then there's AbbVie, with the ticker symbol ABBV. This one sits in the middle. ABBV currently yields about 3%, and its dividend has grown at an impressive 12.5% per year over the last decade. On top of that, the stock has delivered about 13.21% annual price appreciation. AbbVie shows what happens when income and growth coexist. The yield adds weight early, and the growth accelerates compounding over time. Next is Interparfums with the ticker IPAR, which plays a different role. IPAR's current dividend yield is around 3.78%, but the standout metric is dividend growth. Over 10 years, dividends have grown at roughly 20.16% per year, with share price appreciation around 13.46% annually. Lowe's, ticker LOW, rounds things out for John's portfolio. The current dividend yield is about 1.97%. Dividend growth has averaged roughly 16.51% per year over the past decade, and the share price has appreciated about 12.33% annually. Once John had the full portfolio in place, the next step was to understand what the portfolio was actually producing as a whole. To calculate the portfolio's dividend yield, he kept it simple. He wrote down the yield for each holding. SCHD at 3.79%, ABT at 2.02%, ABBV at 3%, IPAR at 3.78%, and LOW at 1.97%. He added them together, which comes out to 14.56. Then he divided that number by 5 since there are 5 stocks. That gives a portfolio dividend yield of 2.91%. That single number tells you a lot. It shows how much income the portfolio produces right now before growth does any heavy lifting. You can use the same process for the other metrics. Take the dividend growth rates, add them up, divide by 5, and you get the portfolio's average dividend growth rate, which for John comes out to 13.84%. Do the same with the annual share price appreciation numbers, and you get an average of 11.52% for the portfolio. Once John understood the portfolio itself, the next question became how to feed it. There are two common paths. One focuses on consistency, the other focuses on the starting scale. Both work, they just feel different along the way. The first path begins with a one-time investment and then lets time do most of the work. The money starts compounding immediately, and progress feels more visible early on because the base is already there. The second path grows through regular small contributions. Money goes in steadily without worrying about timing or market swings. Early progress feels slower because most of the growth comes from the contributions themselves. Both paths use the same portfolio underneath, same yield, same growth, same behavior. The only difference is how the money enters the system. And you can choose any one that fits your pocket. Now let's look at the lowest amount needed to reach $1 million portfolio at roughly $5,000 a month in dividend income, starting with the one-time investment path. For the one-time investment path, John starts with $17,000 up front and adds nothing after that. No daily deposits, no monthly contributions, just time, reinvestment, and the portfolio doing what it's designed to do. After 1 year, the portfolio is projected to be valued at about $19,454. After 10 years, it's projected to reach roughly $67,344. At this stage, progress still looks modest, which is typical early in the compounding process. Between years 10 and 20, the portfolio is projected to cross the $100,000 mark around year 13. That's where the behavior starts to change. Reinvested dividends begin adding noticeable weight, and growth becomes easier to see from year to year. By year 20, the portfolio is projected to be valued at around $286,745. From this point on, compounding plays a much larger role in the portfolio's growth. By year 30, the portfolio is projected to reach approximately $1,335,922. At that level, projected annual dividend income is about $64,453, which works out to roughly $5,371 per month. When you break down the projected growth, the total value added over time comes to about $1,318,922. Of that amount, roughly $920,748 is projected to come from capital appreciation, while about $398,174 is projected to come from reinvested dividends. Now let's look at the projected outcome for the second path, where John builds the portfolio through steady contributions instead of starting with a lump sum. Let's suppose John contributes $7 per day with $0 invested up front. After 1 year, John would have invested around $2,555. This sets the stage for future growth. After 10 years, it's projected to reach roughly $51,550. Between years 10 and 20, the portfolio is projected to cross the $100,000 mark around year 14. That's where compounding becomes easier to notice as reinvested dividends and price appreciation start playing a larger role. By year 20, the portfolio is projected to be valued at around $273,258. From here, growth becomes more self-sustaining, with less reliance on new contributions. By year 30, the portfolio is projected to reach approximately $1,329,766. At that point, projected annual dividend income is about $64,033, which works out to roughly $5,336 per month. Looking at the projected growth over time, the total value added comes to about $1,253,116. Of that amount, roughly $871,876 is projected to come from capital appreciation, while about $381,240 is projected to come from reinvested dividends. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.